strong sell-off in both silver and gold to close this week. The silver spot price appears to be ending today around $15.25 an ounce, a roughly 75-cent cut in price since last week's Metals and Markets podcast. The gold spot price will end this week slightly below the $1,300 an ounce level. It looks to be finishing right around 1,295 fiat Federal Reserve notes per troy ounce. Our guest this week for many of you might be a controversial figure. You see, back in early 2010 at a CFTC hearing, his points in the discussion essentially went viral in the then precious metals community. By the spring of 2011, when the Silver Doctors website began, many silver and gold bullion bulls disparaged this week's guest, including a younger version of myself. Check out this week's show notes for more backstory on what I just described. In my more than decade-long experience in this industry, Mr. Jeff Christian, his research firm CPM Group, and the fundamental data-driven approach they often take, has made many of his market calls not only accurate, but also accurate over many years of time. So a quick advertisement from our show sponsor, and myself, James Anderson of SD Bullion, and my co-host, Elijah Johnson. We will speak to Mr. Christian about gold, silver, palladium, and discuss what are prudent bullion allocation percentages. We also discuss the difference between stacking to never sell versus stacking to never sell, and perhaps speculating with some precious metals with the intention to eventually use those proceeds to invest in perhaps other asset classes or to use them as proceeds to live off. We will be right back after this brief message. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality, investment-grade bullion products. Visit SDBullion.com for more information.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Jeffrey Christian from the CPM Group. Jeffrey, thank you so much for joining us today.
It's a pleasure to be here.
All right, great. Well, thank you so much for coming on, and we also have co-hosting with us on our SD Weekly Metals and Markets Wrap, James Anderson. Now, Jeffrey, the first question I'd like to ask you is about the gold investor demand right now, because you've recently stated and pointed out how in last year, 2018, we saw the lowest gold investor demand since the year 2000. So you also stated last month, January of this year, that the gold market looked as if it were at a bottom. So since then, we've seen a continued rise in the price. So where does gold stand right now?
Right. Well, yeah, it was an interesting year. The last couple of years have been pretty interesting for gold. But the reality is that last year, in terms of physical gold purchases on a global basis, the preliminary data that we have, we're working on our gold yearbook now, the preliminary data shows about 13.8 million ounces of investment demand for physical gold on a net basis. And that is, it is the lowest level since 2000. And it is worrisomely low compared to what we've seen since 2001. But you have to say, I have to point out, in 2000, investment demand was down to like 2 million ounces. It was really the bottom of a bear market. So while we're down from where we've been 2001 through 2015, we are in fact still pretty much stronger than we were in 2000. You are seeing investors last year backing away from gold and focusing on currencies, the dollar, stock market. Our expectation, we're looking at the market, we're looking at investment demand trends, we're looking at the price activity. And what we're seeing is that probably the worst period was the second half of last year. Since November, we've seen some increase in investment demand for coins and bullion, and that's been reflected in a higher price. So we're looking at a market that seems like it got down to the lowest level in the second half of last year, and that as people have become more concerned about the stock market's ability to continue to rise and the state of the world economy and the state of the world political environment, they are beginning to step up their purchases of gold and silver, which is being reflected in stronger prices.
Hey, Jeff, I want to thank you because you're one of the guys out there that has done really good research in terms of gold allocation, performance, et cetera. At the end of 2016, your CPM Group, you guys published a back-tested precious metal bullion versus S&P 500 versus U.S. bond treasuries. It was a study about that expanded from 1968 all the way to the end of 2016, which was basically the full fiat currency era and a couple of years extra. What were the major findings in that study, if you don't mind letting the listeners know?
Well, a little background. There's a fellow, Roger Ibbotson, who's a emeritus professor at the University of Chicago. And Ibbotson Associates had done this study in the early 1980s. They said, if you start with a portfolio that's 50% S&P and 50% bonds or bills, treasury bonds or bills, and you start adding 5% increments of gold to that portfolio, what's your efficient horizon? Where is it where your risks are falling greater than your returns are falling? And what they found at the time, using data from like 1968 to 1980, was that between 5 and 10% of your portfolio ideally should be physical gold to maximize your risk-reward ratio. And that number, 5 to 10%, has been used ever since.
Right.
So we took the Ibbotson methodology and updated it using data from 1968, the beginning of free gold prices, to the current time, end of 2016, and I think we've extended it to 2017. And what we found was that the efficient horizon was actually around 27 to 30%.
Wow.
Which is, it was great because you'd be giving these results in a presentation to a group of financial professors, and that was their reaction was wow, and their jaws would drop. And if you stop to think about it, 1980 to 2000, we've seen some very strong stock markets, we've seen some very strong bond markets, but we've also seen an extended period of time of extremely low interest rates, and we've seen some really nasty declines in the stock market. Right. And we saw this unprecedented bull market in gold from 2000 to 2011. Right. So you put all of that volatility in there and the strength in gold prices over an 11-year period, and the ideal amount of gold, the ideal percentage of your wealth or in your investment portfolio that should have been in gold over that period comes up to 27-30%. Very high, but as someone said on the news this morning, documents document reality. They tend not to lie. And this was pure statistics, and it's using industry standard methodologies, and that was what the results were.
That's crazy. Yeah. Thank you.
It's not exactly crazy. It's very interesting, though.
Well, what's crazy to me is the fact that we constantly still hear it, 5-10% gold. And that's even by people who claim to be gold experts. And they're just basing it off of a 1980 price high, a study that you're talking about, which to me is just interesting. It goes to show you that sometimes you got to dig a little deeper.
Yeah. Well, in 1985, we issued a buy recommendation for gold, and the price, had gone down to, I think, around $320, or maybe it was below $300. And at the time, we were saying, okay, well, part of the issue then was Swiss private bankers and money managers would say, I want to hold between 5 and 10% of my assets in gold. And we thought, okay, well, they've probably drawn down in the bear market from 1980 to 1985. They've probably drawn that down to about 5%. So our estimate is that when they turn bullish, they will be going from 5% to 10% allocation. And what happened was they went from 1% to 10% allocation because in that 5-year bear market, the price of gold and the value of their gold holdings had fallen, but the stock market and the bond market had entered a very strong period of time. So their assets, the percentage of their assets that were in gold hadn't fallen to 5%; they'd fallen to about 1%. And that I think speaks to one of the points you make. People are working on old data and bad data. And, one of the great things about gold and silver is they're very secretive markets. So you really don't know that stuff out there that's out there. But yeah, people tend to rely on old information.
Mm-hmm. Now, I know in a speech you recently gave, you were talking about the idea of between holding gold and silver and trading gold and silver. Can you speak a bit about this and what is the best kind of balance between those two? Because I know you said that really holding precious metals, you can do a lot better trading them actually if you trade them right.
Right. It's a difficult thing because trading them right is a very hard thing to do. And one of the other points that we always make is that, buying and holding gold and buying and holding gold mining shares is in a long run very profitable. You'll spend 20 years losing money, but then you'll make it up in the long run. And that's because of the nature of wealth, But one of the things that we've been doing over the last couple of years is we've been really focusing and trying to get our clients to focus on the idea of, why do you own gold and silver? And the reality is there are many reasons. And, a lot of people will buy and hold gold as a safe haven. They're either convinced that the world's going to collapse or their local bank is going to collapse. So they buy it as catastrophic insurance. And that makes a tremendous amount of sense. But if you look at gold, it is a market. It rises and it falls as investors wax and wane in their interest in it and as other assets do well. And if you look at it from that perspective, gold also makes sense as an investment. And that investment should be bought and sold depending on market conditions and on economic conditions. I look at the people that I've known since I got into this business in the late 1970s and people I knew before that. My parents were big gold and silver investors. And I see that the people who really have done the best have a portion of their wealth in gold and silver as that catastrophic insurance and as a form of diversifying the denominator of their wealth. So you buy and hold some, but then you also have some that you trade as an investment. And, investment advisors always have that disclaimer that says that you should only invest money in this asset that you can lose. So it's sort of mad money, but it's your investment. And one of the points that we make when we're talking to institutional investors and high net worth individuals is you have wealth and you have your investments. And your investments is a subset of your wealth. And you have to think about gold because it has a role in your wealth preservation and your capital appreciation of your wealth, but it also has a role in your investment portfolio. Mm-hmm. Now, in terms of how you divide that up, it really depends on who you are. I mean, we've had clients who were multi-billion-dollar investors, private individuals who were multi-billionaires, and they had a relatively small portion of their wealth in gold and silver, but it was enough for them, their children, and their grandchildren to do well if they lost everything else. Mm-hmm. And obviously they could have done better if they had more money in gold, mm-hmm. according to the data historically. But, that's it. So how much of your money you hold in gold as a catastrophic insurance, buy and hold, and how much you trade with really is heavily dependent on who you are, how old you are, how wealthy you are, where you live, and a variety of other factors. There's really no set formula.
Sure. Hey, switching gears a little bit, Jeff, and just the fact that you've been in this industry ever since the late 70s, I hope we can have you on again another time to talk about those days, because I'm sure you have some interesting stories. I'd love to talk about the Hunt brothers, et cetera. But we only have so much time on this podcast. I want to switch to something that's going on currently, which is interesting, I think, to people listening. The ongoing palladium supply crunch, and the potential worsening of, the demand side equation, giving South African mine strike potentials and, Russia, the way that they've been operating the last few decades between the United States. Is it possible that we may end up seeing another, crazy bubble in palladium prices, something like what we saw in 2001, 2002? Is that something that's out there that could actually happen?
Well, the bubble has already exceeded what we saw in 2001.
Right.
And what we're seeing now is radically different. What happened in 2001 was a combination of factors. You had the Russian government pull back in palladium exports because they realized that there had been some inappropriate sales in the early 90s, in the immediate aftermath of the collapse of the Soviet Union, and they were trying to figure out what to do. In addition to that, you had the tech bubble, and people were buying tremendous amounts of palladium, both for increased use in auto catalysts, but also in electronics. And in the late 1990s, about 85% of semiconductors used palladium. When the price got up to $1,000, and that was because of the shortages in the physical market, you saw major changes, and you lost about 70% of that market. So semiconductor penetration of palladium semiconductors went to 15%, and it's never really recovered. So you had a shorter spike then due to clearly defined supply and demand factors, and it came down. What we've seen now, the origins of what we've seen since 2017 in terms of palladium prices rising sharply, the sharp backwardation, tightness in supplies. These origins really started to emerge in 2012. And it's interesting because we were looking, and in 2012, we were telling our clients, well, palladium is, I don't know, $500, $600 an ounce at the time, but we think it could go to $1,000 by 2018. And it's very funny because, well, we were right. Who knew? And people thought we were insane at the time. But what you've got right now is a very interesting thing. You've got these long-term fundamentals, tighter supply, falling South African production. It's actually kind of flat right now, but we expect another leg down to start emerging in about 3 to 5 years. So you get tighter supply. You probably are seeing demand destruction on fabrication demand, and the auto industry will be moving away from palladium. They have already started it, and that's going to become more prominent in the second half of this year, probably with the advent of manufacturing for model year 2020 cars, where you'll probably see more of that. But you saw tighter supply. You went from very large surpluses in the palladium market. There are a lot of people who talk about platinum and palladium being in deficits. They've got bad data. If you look at the good data, ours, you see that we had very large surpluses of total supply relative to fabrication demand in the period 2000 to 2012 or so. And that started to disappear. And we have had 7 years now of extremely tight supply-demand balances. And that has been reflected in rising prices in the last 2 years and rising lease rates and shortages of material relative to fabrication demand and the backwardated market. But you've also had some other things. So, the trigger began in May, June of 2017, where you had a bad batch of about 3 tons of palladium delivered to an AutoCAD manufacturer. It had too much oxygen or
I heard
moisture.
about that.
And that caused the automaker to go into the market and try to find 100,000 ounces of sponge on a spot basis. Just as we were going through the June NYMEX roll, which was also applying upward pressure. And that really started it. And once that started, there were people from 2012 to 2017 who were watching the palladium market saying this could get interesting. But then when that happened in May and June, that was a clarion call to everyone. And everybody started looking at palladium and saying, wow, this is a market that's much tighter. You have tightness in the sponge market, but you also have tightness in the bar market, which is needed for delivery to NYMEX. And that led to a wave of investors coming into palladium at a time when other metals weren't looking quite so attractive. And it's persisted up until now. Going forward, those long-term supply-demand fundamentals are going to be there for a long, long time. And we have a big deficit, I think, last year, and we have a big deficit again this year in terms of total supply entering the market relative to fabrication demand. That's how you have to measure it. If people who want to be bullish on these things because they market them will throw investment demand in. And if you take the investment demand out of their supply-demand balances, they've got the same surpluses that we've had. we're going to have a tight palladium market for years to come.
Yeah.
And the question is, what happens to investor interest? I mean, we've seen a lot of investor buying over the last 2 years, which has helped fuel that price higher. With the backwardated market and the high lease rates, fabricators aren't leasing metal. They're not buying forward. They're buying for spot, which is adding to the upward pressure. The investors are the key. When they stop buying, do they start selling? Mm-hmm. Investors don't sell their metal when the price is low. They don't sell their metal when the price is rising. They sell their metal when the price has risen and is either plateauing or starting to fall.
Right.
And our expectation a year ago was that would start to emerge in the second half of 2018. So early 2018, we were saying second half of 2018, you may start seeing this shift. Now it's the early 2019, and we're saying, well, okay, in the second half of 2019.
Okay.
Our view is that the price probably plateaus and then ultimately rises again because those long-term fundamentals are still there.
Got it. Thanks.
Moving back to precious metals, you are calling for new possible gold and silver nominal highs in 2022 and 2024, so about 3 to 5 years down the road. What are some of the major economic catalysts that will propel this forward?
Right. The student of history, I always talk about the causes and the occasions. And we have this menu that we published for our clients in our reports, which is the causes for the next economic downturn and financial crisis. And there are many. And the question is not what are the causes, but what's the occasion going to be? So you have massive deficits, which are leading to growing debt. That's true on a government basis. It's true in private individuals, and it's true with corporations. We have been living on the basis of 12% per annum growth in paper money and paper assets since like 1980. And one of the cautionary tales is you've had people saying since 1980 and actually since before that, the world's going to collapse. We can't continue to live with the debt. And in 1980 we had less than $1 trillion in federal debt, and we had a $58 billion budget deficit under Carter. And Reagan ran on the view that that was unsustainable. And everybody was buying gold and silver because you can't live with a $58 billion debt deficit in the U.S. government and $1 trillion worth of debt. Well, fast forward 40 years, and what do we have now? You have $20+ trillion of debt, and you have a $1.4 trillion deficit, which is not a spike like we saw during the financial crisis. This is a long-term secular upward shift in deficit spending by the U.S. government that's not going to get resolved by pulling us out of an economic slump, as was the case in 2009, 2010, 11. So this is a real big problem, and it's not just the U.S. government, it's all governments, it's corporations, it's private. That creates an unsustainable level. Now, it's been unsustainable for 40 years, and we've seen a couple conniptions, like 2008, 2009, that have caused it, but we don't collapse. They paper it over because the price of collapsing, personally, socially, culturally, is so devastating that the governments have bullets, and they will come in and again, as they did in 2008, 2009, and they will do whatever they can to preserve us from rolling over into a depression and a revolution, which is really what they're concerned about because it's their jobs and it's their necks in the case of some countries. So that's the cause. What the occasion is, we don't know. It's probably going to be some obscure corner of the debt market. And it's very interesting because I was giving a talk the other day and I was talking about all of these different causes that will lead to the next recession and financial crisis, and then the occasions that may trigger it. And it'll probably be some combination of things, but it probably will be in some obscure corner of the debt market where it appears, sort of like CMOs. I spent so much time explaining collateralized mortgage obligations in 2008, 2009, 2010 to people who didn't know what they were prior to that effect. It could be a municipal bond market. It could be the equity market because you have like $70 trillion worth of equities globally, about 46% of which are in the U.S., but you have quadrillions of dollars of equity derivatives based on that.
Right.
And everything's cool as long as you're growing. But when you get into a recession, all of a sudden you can't service that debt. And that's what's happened in 1990, 91, 2000, 2001, 2007, 2008. And it's probably what's going to happen again. And it's probably going to start in some obscure place. It might be the money that's been borrowed to buy those derivatives on equities. But at some point, the economy slows down and you can't service that debt. And then it's just a domino effect.
Yeah, it's a spillover effect, essentially.
Right.
So you are thinking, though, in terms that is going to be happening in the coming decade, and that's going to push gold and silver to new nominal highs sometime 2022, 2024 is what you guys are basing it on?
Right. We're talking about record highs for gold. We're actually talking about not quite record highs for silver. We're talking about sharply higher silver prices, but not records in terms of spots. Yeah.
Okay. Got it. Well, Jeff, thanks. Appreciate that.
Yes, well, Jeff Christian, Managing Director at the CPM Group, thank you so much for your time today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Okay, well, I don't want them to find me, but they can find my company at www.cpmgroup.com. It's a website. It's under reconstruction because the company that was running our website got out of that business, and we haven't quite effectively rebuilt it. But you can find out about our research reports, our gold, silver, platinum yearbooks, our trade recommendations that we're now selling, and other research and consulting services. And I want to thank you guys for inviting me to be here. It's been a pleasure.
Yeah, thank you. We hope we can bring it back. It'll be really, really good for us, I think.
Okay. Well, after 41 years, I'm probably not going anywhere soon.
All right, Jeff. Thanks so much.
All right.
Thank you so much.